The Black Friday and July event from Dell Technologies is here with great offers on trusted technology. You'll also discover huge deals on new AI-ready laptops, like the Dell 14 Plus featuring Intel Core Ultra processors starting at $699.99. Save on top accessories, plus enjoy fast, free shipping and other benefits. Upgrade today by visiting Dell.com/deals.
Raise the rudders! Raise the sails! Raise the sails!
Captain, an unidentified ship is approaching. Over.
Roger. Wait, is that an enterprise sales solution?
Reach sales professionals, not professional sailors. With LinkedIn ads, you can target the right people by industry, job title, and more. We'll even give you a $100 credit on your next campaign. Get started today at linkedin.com/results. Terms and conditions apply.
This is Optimal Finance Daily, 6 types of credit cards you need to avoid, by Kumiko of thebudgetmom.com. Many people risk their financial freedom by falling victim to credit card debt. Lousy spending choices and life emergencies can all lead to an unsustainable financial future, but getting trapped by a bad credit card can also lead to problems. Most credit cards are decent, and some even come with great rewards and promotional interest rates. In fact, I took advantage of one of these perks when I used balance transfers to tackle my credit card debt back in 2011. On the other hand, some credit cards should be avoided at all costs. These types of credit cards prey on consumers who have had a history of bad credit and may not qualify for anything better. Even if you don't qualify for the best credit card, you should never accept a credit card that has terrible terms or one that could end up making your financial life worse. Here are 6 types of credit cards that are always a bad idea. Number 1, deferred interest credit card. There are a lot of retailers, such as electronics or furniture stores, that promote no interest until X date credit cards. Essentially, these cards allow you to buy big ticket items like a sofa, TV, or stereo system without paying interest for a specified period of time. Even some healthcare providers, such as cosmetic surgery centers and dentists, also offer these cards. No interest sounds nice, right? There's one huge catch. You must pay off the entire purchase by the time the promotional period ends. If you don't, the lender will charge you interest retroactively back to the date you bought the item. For example, let's say you bought a $2,500 bedroom set on December 22nd, 2017, with a 1-year promotional period. If you pay off only $2,000 by December 22nd, 2018, you'll be charged interest on the entire $2,500 dating back to December 22nd, 2017. When you bought the bedroom set. If you think there's even a slight chance you can't pay off the entire balance by the end of the promotional period, you need to avoid a deferred interest credit card. Number 2, credit cards secured by your purchases. Some credit card lenders may claim to take collateral on items purchased with the card. If you have problems making any payments, they may threaten to repossess property bought with the card. Most threats to repossess such personal property are not carried out because the expense of repossession outweighs the value of the used property. But it's still a good idea to use an unsecured credit card instead of a secured credit card whenever possible. Number 3, credit cards secured by a bank account. There's another type of secured credit card that allows you a credit limit up to the amount you have on deposit in a particular bank account. If you fall behind on payments, you'll lose the money in the account. These type of credit cards are usually marketed as a way to reestablish credit by showing that you have moved past financial problems and can make regular monthly payments on a credit card. Using secured credit cards to help build credit can be tricky. If you can, it's always best to not tie up the money in your bank account. You should only use these types of cards if you know you can make the monthly payments and pay off the balance every month. Number 4, credit cards secured by your home. Some lenders offer credit cards in connection with your home equity line of credit. Every time you use your credit card, the balance is secured against your home. Home-secured credit cards are always a bad idea. The potential consequence of not making payments is the loss of your family's shelter, which is a necessity. Some home improvement contractors offer these cards as a way to pay. Always beware of contractors offering this type of credit. Number 5, fake security deposits. Some credit cards will claim that they don't require a security deposit, but then charge a deposit to the card. The massive problem with these deposits is that these cards usually come with extremely low balances. Once the security deposit is charged to the card, it eats up much of the credit line. The Credit Card Act limits these fake security deposits to 25% of the credit limit. However, you should avoid these types of fake secured cards. And number 6, convenience checks. Another offer you may receive from a credit card takes the form of a check mailed to your home, usually by your credit card company. When you cash the check, you not only accept higher interest rates, but you also get stuck with a significant balance on a new account right from the start. When they send you the check, they may make it sound like a generous gesture on their part, like it's a gift to you for being such a loyal cardholder. Never mistake this as free money. Remember, if you receive one of these convenience checks, it's your credit card company's way of offering you the option to write checks attached to your own credit card's account limit. Before you apply for any credit card, make sure you understand the terms and conditions of the card. Learn about the interest rate and make sure you fully understand the consequences if you can't make a payment. You just listened to the post titled 6 Types of Credit Cards You Need to Avoid by Kumiko of thebudgetmom.com. This message is brought to you by Apple Card. If you're like me, you might be considering getting a new iPhone. But have you considered upgrading your credit card? When you use your Apple Card with Apple Pay or the laser-etched titanium Apple Card, you can earn unlimited 3% daily cash back on everything you buy from Apple, whether it's a new iPhone, an iPhone case, or even a service like Apple Music or Apple TV Plus. Earning 3% back on the Apple products and services you love? It's an easy decision. You'll only wonder why you weren't doing it sooner. Subject to credit approval. Apple Card issued by Goldman Sachs Bank USA, Salt Lake City branch. Terms and more at applecard.com.
This episode is brought to you by State Farm. Knowing you could be saving money for the things you really want, like that dream house or ride, is a great feeling. That's why the State Farm Personal Price Plan can help you save when you choose to bundle home and auto. Bundling, just another way to save with the Personal Price Plan. Prices are based on rating plans that vary by state. Coverage options are selected by the customer. Availability, amount of discounts and savings, and eligibility vary by state.
This article made me reflect on the various predatory lending practices out there. According to debt.org, predatory lending is any lending practice that imposes unfair or abusive loan terms on a borrower. It's also any practice that deceptively convinces a borrower to accept unfair terms for a loan that a borrower doesn't need, doesn't want, or can't afford. An example of this is when a lender hides in the fine print or misrepresents the true costs, risks, and/or appropriateness of the loan's terms, or the lender changes the loan terms after the initial offer. One of the most common practices among predatory lenders is loan churning, where the borrowers are forced into a relentless loan cycle in which they're constantly paying fees and interest without noticeably reducing the principal amount owed on the loan. Loan churning usually works like this. The lender makes a loan the borrower can't afford. The borrower fails to pay the loan back on time, so the lender offers a new loan that includes another set of fees and interest. The borrower, already under stress for not repaying the first loan, agrees to the second loan, and the loan cycle churn has started. The Consumer Financial Protection Bureau says that 94% of repeat payday loans happen within 1 month of the first loan, and that consumers using payday loans borrow an average of 10 times a year. The interest and fees amount to $2.1 billion for borrowers. Borrowers often end up paying $450 in interest alone for a $350 loan because of loan churning. It's commonplace among predatory lenders and something consumers with a poor credit history should be on guard against. And that should do it for today. Have a happy rest of your day, and I'll see you on the Thursday show tomorrow, where your optimal life awaits.